You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo, coming to you from the options capital of the world here, sunny. Actually, relatively sunny until today, and scenic Chicago, Illinois, from the old Options Insider Studios, where we produce a wide variety of fine content that you could find pretty much anywhere you find your favorite audio, including probably the easiest place is our mothership, the flagship, theoptionsinsider.com. You can surf on over there, read some unusual activity, read some breaking news from the options market, and then when the mood strikes you, click on that Insider Radio Network tab, top left corner of the homepage, and all 13 programs pop up, including many episodes of Volatility Views for you guys to stream or download, whatever you prefer. And while you're listening, of course, send us your questions, your comments. We love to hear from you guys. You can also find us iTunes, TuneIn, Stitcher, pretty much everywhere you find your favorite podcast programs, including our own mobile app, available in pretty much all of the major app stores. I know a few of you have been writing in saying, hey, we're even running the Amazon version, so I'm glad to see some love for the Fire OS version. We didn't make it for no reason, so at least a few of you getting some use out of it. And of course, all that feedback stuff I mentioned, it's all baked into the app as well, so you can shoot us your volatility questions, your comments. Maybe you just don't like Mark Sebastian, whatever the case may be, let us know. We love to hear from you guys. And speaking of the Greasy Meatball, he is one of the many people joining me on this jam-packed episode of Volatility Views. So we'll start with you, Mr. Greasy Meatball. Welcome back to the Volatility Views program, sir. It has been too long.
2 weeks without Seabass is like 2 years without pizza.
It was like I was adrift in the desert for 2 weeks, and now I'm back in the oasis of volatility.
It's very much like that movie Outcast. You were Tom Hanks. I was the FedEx plane.
I don't think it was called Outcast. It's called. I know what you're talking about, though. Yes.
What was it?
Castaway.
Yeah, Outcast is different, a little different.
I'll be Tom Hanks. You can be my Wilson. I missed my Wilson. My blood-drenched volleyball, which is a very gross metaphor. So we'll just move on from that very quickly. Also, welcome on our other new volatility regular here, co-host here on the old program. You may remember him from his many appearances, including last week's return to form here on the program. He is Russell Rhodes, the senior instructor over there at the Options Institute, as well as an author of several fine options tomes. Russell, welcome back to the Volatility Views program, sir.
I've never heard what I've done referred to as writing tomes. There's a new one.
That's what we do here on this network, Russell. We find new and exciting ways to describe things.
Okay.
We're full of euphemism and metaphor on every episode. That's what we do. That's why we get paid the big bucks.
I understand.
And arcane, options can be a little bit arcane, so I think the term tome can apply. Not unfitting at all. And we are also joined, like I said, it's a jam-packed show, listeners, by our third special guest co-host. He is Kevin Nichols, the Director of Business Development over there at CBOE Live Vol. Kevin, welcome to the Volatility Views program.
Hey, thank you very much, Mark. Happy to be here.
Kevin gets to draw the short straws episode because he's actually in town, but he has to beam in remotely nonetheless. So we'll get him on in person, in studio, really soon, listeners. But Kevin, before we dive into the show proper, because this is your first appearance on the network and indeed on the Volatility Views program, why don't you go ahead and give our listeners a little bit of an overview of your background in the options and derivatives markets, and then kind of a quick primer on what it is that you guys do actually at Live Vol.
Oh, great. Thanks for asking. So my background, I started trading options as a market maker back in March of 1995. Back then we had 4 exchanges, and that was 3 too many. We're now up to 13 and counting, I believe. So it's been quite a ride. I've been involved with Live Vol for about the past 7 years. Live Vol is a proprietary, analytics and options analysis firm. We take the consolidated opera feed and live underlying data and crank analytics out on all 4,000 plus symbols that have options. The founders saw that the markets were becoming very fragmented, and they needed to create a virtual pit to see all of that activity across the numerous exchanges. So we created Live Vol Pro as our first analytics platform to get that view and create a virtual pit and see all of the activity across the numerous exchanges. We're now also have that was a professional version. We also have a retail version called Live Vol Core, and finally an execution platform called Live Vol X. So when it comes to volatility, we're your firm.
Well, it is in the name there, which is why we wanted to have you on here on the Volatility Views program. And of course, I'm a big fan of a lot of your different platforms, including the Live Vol Pro. I run it for most of the shows that we're doing over here, including this one. That's where we pull a lot of our real-time analytics while we're recording our programs from your platform. So, and I've always liked the fact that it really was designed first and foremost for options users. You know, if you're using a brokerage platform or some other platform, you have to click through myriad different tabs to get past the stocks and the mutual funds to get to what you really want, which is the core options functionality. And you're right, Ron and Stefan, your founders, they really designed this first and foremost with options market makers in mind. So there's a lot of options analytics really quick at your fingertips, which is why I like to use it. And it's perfect for us on these shows because we need to get the stuff fast. So it's always been one of my favorite platforms, and we're glad to have you on the program. If listeners can't figure it out, we are in the process of establishing a nice little partnership here with CBOE and Live Vol. So you can expect to hear more from these guys on the show in the near future. But Kevin, he was kind enough to volunteer to join us as a co-host, like I said, on the program today. So without further ado, let's dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that music means it's time, once again, for the Volatility Review. If you're just joining us for the first time, first off, where you been for the past 4 years? We've been doing a lot of great vol stuff on this program. But A, welcome, and B, this is indeed the portion of the program where we break down what caught our eye in the week that was, and indeed still is, as we're recording this program here on Friday, November 6th, for all of you playing the home game right about the middle of the session, midday here on the 6th. And we are in a bit of sell-off mode in most of the major indices coming off the heels of non-farms this morning. If you've been listening to the show for any period of time, you know non-farms have been an interesting point of discussion that kind of had been relegated to the back burner, it seems like, for the better part of the past year or so. They kind of became a non-event. And then a few months back, all of a sudden, non-farms show they still had the ability to move the markets a little bit, inject a little bit of volatility premium back into the markets. So we saw people starting to do what they had always done traditionally in non-farms, which is actually starting to bid up a little bit of vol going into these events. This week was a little bit of a weirder scenario. They actually kind of sold it off and they brought it back in. We'll talk about all that in a second. As we are, of course, recording this, we are hovering, like I said, down about 0.5% in the S&P right now, and the VIX cash ticking up, hovering right about near the 15.5 handle or so, up a little bit here on the day. So a lot to parse. I think, Kevin, because you're our guest, we'll give you pride of place What caught your eye in the week that was, and indeed still is, from a volatility perspective?
Well, there were some interesting stock-specific moves. We have earnings season going along, and there were some definite players picking their spots. I saw some interesting trades go up. I tend to follow order flow, and saw some activity in particular going into cores. Definitely some bullish activity, trying to take advantage of selling some of the front-month volatility, expecting good news out of cores, and they delivered. So I tend to see that stock-specific trading, taking advantage of overpriced volatility, selling it into announcements, and then some people picking plays on stocks that let's say got hurt a little bit more than the market was expecting. I think Whole Foods got hammered a little bit, so market was caught a little bit off guard on that one.
Yeah, it has been an interesting, almost you can call it a bit of a bifurcated earnings season. We'll get to earnings vol in a little bit, but it does seem like it kind of has been a bit of a tale of kind of two seasons where early on some of the big names, Amazon and Google, really kind of just blowing the doors off everything, and it seemed like maybe that was setting the tone for the season. Then it seems like post that, except for a few names, it really seems like premium sellers have actually been winning the day so far. But we'll get to all that in a little bit when we get to the earnings section of that. But before we do that, we'll turn our attention now to one of our other co-hosts, Mr. Russell Rhodes, over there in his fabulous corner office at the Options Institute. Russell, what caught your eye this week from a vol perspective?
Well, one thing that caught my eye was the reaction that we're getting, today in response to the non-farm payrolls. You mentioned that we're selling off, and VIX is working its way up a little bit. Before the number, which is a little contrary to what's going on, I did a little number crunching and threw a blog out there about basically the title was a reality check on VIX, SPX, and non-farm payrolls. And what I did was I took a look going back to 2007, what the S&P 500 has done, just on an absolute value basis as far as a reaction to non-farm payrolls. And there was a 1 basis point difference between the average S&P 500 day on non-farm payroll day versus any other trading day. So, even though everybody braces and the press gets all excited about non-farm payrolls, and they even have somebody stand outside in Washington, D.C. near the Labor Department and read a report to us, it's not much different than an average day. Now, you mentioned that it hadn't done much to the market as of late, so maybe I need to go back and see if recent price action influenced that. The other thing was VIX on a percent basis, and I know this drives Mark Sebastian nuts, but on a day-over-day percent change basis, VIX is actually less volatile on non-farm payroll days than it is on any other trading day. So, which I found kind of interesting. But then the final thing that I found was VIX is more likely to drop on non-farm payroll days than any Friday or any given trading day. So I think what you're getting is something that I've always anecdotally thought, that the earnings or the employment report is a lot like an earnings announcement for the overall market, and SPX volatility is a little elevated going into it and comes off a little bit afterwards. And I think I kind of proved it by looking at the numbers this past week.
Well, Russell, while Mark stews about percent of percent, because I know that's one of his favorite topics, I like to twist that knife myself whenever possible. But I think you're blowing the minds of a lot of our listeners here, because it is kind of almost just an assumption everyone has that non-farms is this great source of turbulence in the market, is this great source of volatility, is this great mover and shaker in the markets. Like I said, last year or so, notwithstanding the last few months, that seemed to have died down a bit. We kind of were looking at non-farms as a bit of a non-event, and then all of a sudden it seemed to come alive a little bit, and we started to see people actually buying some premium going into the number again, which we hadn't seen for a while. That kind of used to be the way it always used to play out back in the day. That's why we like having you on the show, Russell, because you actually put some numbers to the assumptions, and yeah, that's that to me is fairly surprising that you think you'd have at least a bit more of a bump to non-farm just from so many people paying attention to it, if nothing else. It's like the old indicator argument, is an indicator of any value if no one really follows it, and you think non-farms, just from the sheer amount of attention it would have and the sheer amount of volume around it, would be a little bit more turbulent, but it sounds like the numbers are putting the lie to that.
Well, I will give Russell credit in that using VIX percentage movements as a way of looking at how much VIX is actually moving around, I think maybe is a little more valuable than just quoting it as, just giving the percentage up or down on a given day. So I'll give Russell a pass on this one without starting a big argument.
By the way, VIX is up 2% today, Mark.
So, it is an index, but it's a volatility index, and volatility inherently means percentage. So even if there's no percent there, but the big piece that I'm looking at today, VIX futures have been really stiff. We basically seen VIX since they kind of blasted it earlier in the week. Just kind of, even as the market kind of moved a little bit higher, kind of creep higher from the third on. And it's going to continue some of that today. It'll be interesting to see whether they give it a little bit of a sale blast at the end of the day today. But I don't know. I think, and Russell probably agrees with me, I think that 15 is the new 12, and that we're now in a regime where, traders need to get used to 15, 16 being the low end, and movements back toward 17, 18, 19 being much more regular.
Yeah, it was a weird week to watch, the term structure out there in the VIX futures, because they kind of bid it up. They got fiendish, and then all of a sudden it seemed like they collectively realized later on in the week, wait a minute, maybe we overdid this a little bit, and they just crushed everything across the board, and particularly the near portion of the curve. And then they started to bid it up a little bit again, going into the non-farms, and now coming out of it a little bit again today. But it was kind of a weird bit of the lemmings are going this way, now they're going that way. It was an odd thing to watch the term structure this week out there in VIX futures land. Of course, you mentioned VIX, quieting down a little bit this past week. The VVIX, of course, on the lower end of the range that it's been, hovering actually in the 80 handle. It was, of course, well over 100 there for a time. So on the south side, not perhaps as much rocking and rolling going on out there. And, of course, we are hovering right around the 15 handle or so right now. Russell, on the last program, we gave you a little bit of a homework assignment. I'm curious. You were so busy digging up non-farm data, you probably didn't have a chance to do it. But we were talking, because you previously had put together that infamous list of streaks above the 20 handle. I know there's a lot more data points below the 20 handle, but I'm curious, have you had a chance to at least glance at longest runs below 20 marks? 15 is the new 12 notwithstanding?
No, because our social media people said go look at things around non-farm payrolls.
You got to do what pays the bills, right?
Exactly. I didn't get the corner office with the view of the post office for nothing.
Yeah, that's true. But we are in an interesting era right now where I think there is a lot of interest in what Mark's saying about 15. It does seem like we're kind of camping out around this level. We certainly came off at 20 in a hurry out there in VIX cash, and we seem to have settled around. I think we dipped briefly into the 13 handle earlier this week from a VIX cash perspective, and then it kind of just popped back up into the 16. It's kind of been vacillating around that 15 handle for some time. In terms of things quieting down, we talked on some recent episodes about how that the Skew index was really kind of just on fire for a while there, and we really got deep into it last episode on some of the myriad nuances that go into that calculation and why it's sometimes so obtuse for some of the end users out there looking at these numbers over 100 and trying to wrap their heads around them. But it was really high. It was into the 150 range, where if you follow the Skew index, that's pushing some serious levels out there in the Skew level. And then it kind of came off, and now it seems to have settled around the mid 130 range, hovering right around 135 again this week. Showing again there is some interest out there in the puts, a bit of a premium, but not the alarmist levels you could say back in the 150 range. From a few weeks ago. And turning our attention over to the land of the mothership, the big VIX options, it was a bit of a quiet week all in all, which is kind of surprising, I think, given the fact that they were crushing the futures so much and crushing the vol so much. And of course, we had a lot of earnings this week, and we had Facebook and others coming out earlier this week, and we had non-farms at the end of the week. I think a lot of people assumed it might have been a bit of a more active week than it ended up being, but from an overall volume perspective, wasn't the biggest week from a VIX options perspective. Most of the days, under or well under that, 500,000 level, and certainly under the roughly 800,000 ADV that VIX has been putting it up lately. It looks like a little bit of volume today, doing about nearly 370,000 contracts so far, about halfway through the session, and digging into some of those numbers. Open interest, though, despite the fact this week is fairly light, open interest overall still fairly strong. We got about in the 75th percentile for 1 year at least from total options open interest as well as put and call open interest. So still some strong action net out there in VIX-land, even if this week not exactly lighting it up. And since we're talking about weeks, let's get into the weeklies as well. We kind of hit on it last week, and Russell, you made some interesting points about how the weeklies were really seeing some size open interest. Again, a lighter week this week, but still it seems like the weekly going out this week still has a decent amount of open interest out there on those levels as well. I also want to mention too, because we had a lot of people writing in when you guys first listed the VIX weekly, saying, "Hey, why isn't there a full strip? What's going on with this? Why are there only two VIX weeklies?" This is now apparently the first time we can really sink our teeth into that full weekly strip. I'm going to cheat here and bump up a comment from the listener mail just so we can read. This is one of many we got on this subject. This comes from Mark B., a frequent reader and listener. He says, "Hey, the full VIX weekly strip is up for November, and all 4 weeks of healthy volume and open interest. Yay!" So that's the comments of our listeners there, Russell, and many of them are in that same boat. I'm just kind of curious if you're familiar with this. Was this the plan to always to kind of test the waters with just the first few weeklies and then expand it if it worked, or and now we're looking at the full strip for the rest of the time? Was this always been the plan all along?
I'm not really sure if that was the plan. If anything, we put a couple out there and they traded particularly well. So if the plan were to go slow, it probably got sped up a little bit. Because we were getting that, you asked me that question, and I'd gotten that question from multiple people about, why don't we have the weeklies going farther out? And it's kind of funny that I was doing a little digging for things to talk about as we go along, and it turns out that a couple of the block trades today are in weeklies that are a little bit farther out. Somebody bought 8,000 of the November 24th 14 puts, and somebody bought a little over 6,000 of the December 1st 14 puts. Just buying them outright, not even doing a spread. What's interesting to me about that is Mark Sebastian just said that he thinks 15 is kind of the new 12. I think 14 is kind of the new 12. So we sort of agree there. I just find it interesting that you'd have somebody buying, puts expecting lower VIX going into the end of the year. But it's nice to see block trades in the weeklies already.
Yeah, I'm looking at those numbers now. We had those pulled up here. That seems to be, if there's been any narrative this week from the lighter volume, it seems to be buying downside out there in VIX-land, whether it's in the weeklies or in the regular monthlies. That's kind of puts have been the order of the day. You mentioned that 8,000 block total of about 16,000 going up on those VIX expiring on the 24th, 14 puts, as well as 16,000 on those expiring on the first 14 puts. Looks like a bit of a time stupid, actually. Again, no open interest, obviously, on the DEES, and a negligible open interest on the NOVE. So this is all open in paper out here, and that feeds into what we've been seeing on the big VIX options as well. Before we get into that really quickly, Kevin, I know you guys do a lot of data and analytics, obviously, over there. Live vol, it's kind of your bread and butter. I'm curious from you guys, the perspective of adding a new product like these VIX weekly options. Have you seen a lot of uptake from your users? Have you gotten a lot of feedback from people saying that they're interested in these VIX weekly options? Have they been using them a lot? And kind of in general, walk us through a little bit really quickly of like what that is for you guys. Is there a lot behind the scenes to have to actually add a new product like this? And how does that all feed into the whole live vol system?
Well, it's pretty straightforward coming from our data providers. So it's very much plug and play. What we are introducing to expand out our VIX and volatility offerings in general will be the CFE futures data. So we'll be bringing in specifically VIX futures data into our platform, which I think just gives you a more complete picture of the product and should just stimulate trading that much more. I think having more options, I like having options. What can I say? So being able to trade that out a bit farther than the first 2 weeks sounds appealing to not just me but to our clients as well. And Russell has been doing a great job of getting the news out on how to use volatility for your portfolio. So I'm excited to spread the news as well to our clients. We've tended to have stock-specific interest, but as we've recently teamed up with the CBOE, we've been converted, if you will, to the volatility products, and understanding that that is an asset class that you can use to augment your returns and protect yourself. So we're excited to get the news out.
That's actually interesting, because I know that's one of the questions we received most about your platform is, hey, when are they going to add some sort of futures component to it, whether it's futures options or the data themselves? Do you have any time frame for when that's going to roll out?
First implementation should be by the end of November, and we'll expand beyond that. We actually do solicit feedback from our customers for features and just basically viewpoints on how they'd like to see it presented. So not just the CFE data we're bringing in, but other features within the platform. So we'll be rolling that out and expanding our coverage there in the months to follow. But we should have that in our platform by the end of the month.
Oh, that'll be really interesting to look at. See that partnership with SIBO already starting to pay dividends. Interesting stuff. Looking at some of the rest of the paper that was lighting up, like I said, there was a brief flirtation earlier in the week. Seemed like a little bit of premium selling coming into VIX-land, big trades like the Nov 22 is going up 20,000 times, paper selling for 45 cents. But they really weren't, I mentioned it was a light volume week, listeners, there really weren't a lot of other really sizable trades to parse, with the exception of essentially this put love that was going on for the rest of the week pretty much. One of the bigger trades actually we saw out there in VIX-land this week it was a sizable purchase of the Nov 14.5 put, 60,000 or very near to it for about 19 cents yesterday on Thursday. That, of course, comes on the heels of all this other put love we've been talking about, including stuff today like those puts going up today. We also see in the regular Nov, the Nov 14 puts and the Nov 15 puts both trading for size today, 19,000 and about 16,000 contracts respectively going up on those strikes. There's a ton of open interest on both of those strikes, so it's hard to tell for sure if it's closing or not. But if it's falling in line with the narrative of the rest of the put buys out here, good chance it might indeed be opening. Mr. Sebastian, over there in your pitch chat, obviously the weeklies have been catching your attention quite a bit. Is this put love narrative catching the interest of your mentees, and what else was really lighting it up from a VIX perspective over there this week in the chat room?
My mentees are generally put buyers on the volatility ETNs and call sellers or premium sellers of VIX premium. And I think the addition of CFE data live vol is going to be a big deal. That's going to be awesome. It's one of the, it's quite, one of the nice things is probably the best platform to actually trade VIX options off of because they accurately calculate volatility. It's amazing how they're able to make the VIX future the underlying of VIX, and so many other brokerage firms can't figure that out. But we've got guys really starting to take hard looks at the weeklies. I've been going through the data, and I'm going to be spending the next couple of weeks parsing out, basically interpolating, really extrapolating how VIX weekly trade over the last 7 or 8 years, just using the 1 week that we have. Although now that they're going to be listing them over and over and over again, I'm going to have to look at all sorts of different durations for trading VIX puts and trading VIX calls and different types of spreads, because the ability to pinpoint risk is going to be such a huge deal. These having these November 11 weeklies against trading S&P today would have been a really valuable thing to have. Although, to be honest, the S&P is really, vol hasn't moved that much out of, after non-farms. But I'm there's a lot of exciting things, I think, around the weeklies, and it's nice to see albeit a derivative of a super successful product, but it's great to see a successful product come out of the CFE/CBOE again.
Yeah, and you're right. If you're looking at the history of some of the other weeklies we've seen out there, like, I don't care what product they've been listed on, futures, options, equities, whatever, it seems like they really came alive when the full strip was available so they could trade week 3 versus week 1, for example. It opens up many more strategies than just a couple of different sessions. So, these weeklies have already been lighting it up, so it'll be interesting to see now with a full strip available to them for the foreseeable future how much they actually start trading in and amongst themselves. Like we already talked about earlier, we're already seeing some week-to-week spreading and trading, or just outright, in this case, outright buying. So we'll see how that plays up now that there are more weeks to choose from. Like I said, a bit of a quiet week on the overall VIX volume front. So the hot strikes, pretty similar to last week. We'll run through them really quick here. Starting off with the number one, still the Nov 20s with about 325,000 contracts open out there, and about the similar number on the Nov 30s again out there. So similar numbers out there. Then number 3, the Dees 20s dropping off quite a bit, 264,000 contracts open there. Then we go all the way out to January, the Jan 30s, ever optimistic, 260,000 open over there, and a similar number on the Nov 25. So the number 5 spot. Number 6 comes in at the Nov 26s, 220,000, and we drop off again, 195,000 open to the number 7 spot, the Jan 22s, followed by the Dees 30s, 168,000 open. Got to go all the way down number 9 to find the first puts on the list. You think all this put love this week would have bumped a few more up, and it was indeed the Nov 15 puts, lighting it up to the tune of 165,000 contracts open on that strike. We didn't have today's paper in this list, maybe, so I kind of wonder how that will play out going forward. And for next week, and then of course number 10, the Dees 25s with about 158,000 contracts open, about 7.6 million contracts open total out there in VIX-land right now, about nearly 5.5 on the calls and about 2.2 million on the puts. So nothing too outlandish on the call, the put side either, pretty much in line. And as Kevin alluded to earlier on the show, we are, of course, in the teeth of earnings season, and it did kind of seem earlier on we saw a lot of really rocking and rolling. Some of the big names, Amazon, Microsoft, Google, etc., even LinkedIn, really just blowing the doors off their earnings vol, off their straddles. But a lot of the other names seems to really surprisingly underperform. Even names like like Apple, who traditionally rock and roll, didn't really have the extent of the move I think a lot of people were expecting. We saw some interesting developments out there in some big names this week. Facebook earlier in the week pricing in about a $6 move, which was at their current level about a roughly 6% move. They were pricing in, and it did gap up most of that range. So Facebook, one of the ones that came pretty close, closing up nearly $5 on the subsequent session. Of course, had an interesting range after hours, but unless you're hedging your gamma in the after hours or doing something to that effect, it's kind of hard for a lot of our listeners to really participate on that. I won't get into the after hours discussion again. That opens up a whole big can of worms. I did have someone write in recently suggesting we should make our own after hours options exchange at Options Insider, which I thought was an interesting idea. Not that I want to deal with any of the logistical hassles of that, but it would be fun. And we also saw Disney also this week coming in, pricing in a pretty decent movie. You've been following Disney of late. It's kind of been very, very choppy out there. They sold it off aggressively in August on the heels of a lot of the news coming out of ESPN and others really kind of weighing against them. Then it seems like the market collectively decided that wasn't the case because it rallied pretty much back to right where it was back in earnings season, and they were pricing in a pretty decent move, a little over 4% or nearly $5 straddle out there in Disney. And what we saw was a little bit of vacillation in the after hours, but essentially it kind of opening up with a bit of a whimper, almost unched on that one. So a lot of these names underperforming. Has that been your narrative as well, Kevin? Obviously, you're looking at a lot of these, a lot more than we are here on the program because, through your live vol platform, you're seeing, a lot of the earnings going up. Do you have a sense that was kind of the way it was playing out? Things are kind of overperforming. Now they're kind of underperforming, or do you maybe have a different take when it comes to this earnings season so far from a vol perspective?
It's really, like you said, kind of a tale of two cities where you've got some that are yawners, if you will, as Disney. You mentioned with Disney, it's sort of the force is strong with that one, if you will, and then others that you find out when the tide goes out, they're the ones swimming without shorts and just get hammered. I think we're shifting from this stock-specific interest right now and stock-specific picking to some macro views as we dance with the idea of a Fed rate increase in September, and now we're reaching out again coming into December. So I think this is probably the season where the easy money is gone, and now it's you're seeing the wheat separated from the chaff, if you will, because Facebook still strong. Twitter and Yelp and others not doing so well, and you're really seeing them pick their winners, and those are the ones that are probably going to be strong going forward.
It sounds like they're doing a little bit of construction behind you over there, Kevin. But it's interesting stuff nonetheless. A lot of things cooking, obviously, from an earnings perspective. Mark, I know I'm sure your chat room was pretty active out there watching a lot of the earnings this week. Were any of them out there playing in Disney? I'm sure they were active in Facebook. What was catching their eye this week from an earnings perspective?
Yeah, Facebook was super active, lots of trading. Disney, some, obviously next thing, I think Facebook Weight Watchers was one that we'd been playing around with, looking for a short squeeze, and that one paid off. Talk about if you're looking for the definition of a short squeeze, I give you WTW. It's the what that stock has done to the people that were just obliterating it. And by the way, hats off to Oprah laying off several hundred employees in Chicago while making north of $400 million in Weight Watchers in the same week. Way to go.
Yeah, the Oprah effect just keeps on giving out there in Weight Watchers. This thing, I think everyone thought it would be a bit of a momentary aberration, and then the squeeze was on, and it's been squeezing and squeezing ever since. It was back. What was it? It was back in the 6 handle when they made that announcement. Gapped up pretty high. Then it kind of seemed to settle in around the 16 to 17 handle range. And they have earnings earlier this week, and off to the races to the upside yet again. Trading today as we speak here about a little over $23 out there. So you're talking essentially a 4x increase since the big O jumped in on the old Weight Watchers. So I guess the Oprah premium combined with a bit of a short squeeze is a real deal. I'll turn in our attention to some of the shiny stuff out there. A lot of you guys have been watching gold kind of vacillate around. We've been discussing it a lot on the program as well. We discussed how very recently the calls were kind of the name of the game out there. There was a hefty premium to the upside. A lot of people were loading up from a vol skew perspective on upside calls. We were talking about people over at Barclays and others coming out and recommending 1x3s. It was so hefty up there to the upside. That seems to have shaken out a little bit this week. That smile's still up there, but looking at the term structure out there in the big gold options, it's definitely the puts that are leading the charge this week. So perhaps some of those vacillations have taken off a little bit of the upside love. Nowhere near as hefty as it was. And from a vol perspective, GVZ hovering right about 1770 or so right now out there in gold land. Mr. Rhodes, I know you've been pretty busy watching things like non-farms and just enjoying that spacious corner office. Have you been paying attention out there in the commodity land, in particular the metals? Anything catching your eye out there this past week?
Not necessarily in the metals, but the oil. I was actually asked to take a look at oil by one of the networks, and we've had multiple things that really should have pushed oil. It should have caused it to break out, if you think on a fundamental basis. And the OVX, which is the oil volatility index, it's been hovering around the 40s for some time, which means the market is braced for something to happen. And when you're not seeing it break out to the upside, you got to think that that the risk is maybe to the downside. And I would not be the least bit surprised if we see oil in the 30s before the year's out, because it's kind of wound up and ready to break in one direction or another, and it just doesn't seem to be getting any traction to the upside. So you're just kind of getting that from the volatility market as well as the fundamentals.
Yeah, we're looking here at, of course, the skew, and we'll try to include these graphs for you in the show notes, listeners, too, so you guys can follow along, looking at the different curves out there and the big WTI options. And you're right, despite the fact that we have been languishing somewhat in this 40-odd range to 50 for quite a while, the bias is still to the downside. In fact, we just recorded an episode of our Long and Short of Futures Options show, the show we do with the CME over at the big Futures Industry Association conference this week in Chicago. That'll be coming out on the network soon, listeners. One of the main topics we were talking about was the incredible bid out there in puts in products like WTI, and how it's not just a near-term aberration. If you compare actually the risk reversals going farther out, all the way out to D's of 2016, some of the heftiest put premium they're seeing versus the calls is actually a year or so out in the D's 2016 range. So, and that's borne out by these graphs and these charts we're looking at here. So that is very interesting. People are wagering heavily and very concerned about longer term downside than I think a lot of people might assume when they initially look at the graph of crude, see where it was a year ago, and see, oh, we're kind of vacillating here on the downside, but let's spec to the upside. Maybe some of that bullish love got burned out in that big flurry we saw when crude first settled about 6 months ago down around the 60 handle or so, or 70 handle. We saw a lot of people specking to the upside. The CFTC reports and others showing huge bullish positions coming in. They all got wiped out in the subsequent downside moves. Maybe that squeezed out a lot of the oil bulls. I don't know. But either way, yeah, from your data, I'm talking to CME and looking at this data here again today, everything is showing that heavy bias to the calls, or excuse me, to the puts, and for a substantial period of time. It's not just into Jan or anything like that. People are concerned about downside in crude going out until at least the end of next year, which I think may be surprising to a lot of folks. Well, we love these shows with a lot of guests here, but it means we also go long all the time on the Vol Review. We have a lot of great stuff to get into this week, a lot of things rocking and rolling, but I want to make sure you guys get some time on the old program as well. So without further ado, we're going to dive right on into our volatility voicemail.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Volatility Voicemail. Like the man said, this is the portion of the show where you guys get to join us, and I felt bad last week. We ran a little long, didn't have a chance to get to you guys, so we got a bit of a backlog of questions. We'll see how many we can get to. First one comes in here from Adam S. This one obviously came in last week prior to Apple earnings. Didn't have a chance to get to it till now. He writes, hey, hello. Is there a correlation between implied volatility and the move in the stock before earnings? I noticed that Apple implied vol is still 33%, even though they will report on Tuesday. Does that imply that there will be a small move? Netflix was in the 80s and it moved 10%. I sold the puts and I still made money. Well, there you go, Adam. Would you sell Strangles out of the money to benefit from vol collapse? Well, there's a couple of questions rolled into one. We've discussed the latter one quite a bit. Positioning pre-earnings. Should you go short vol? Should you go long vol? And the myriad pros and cons of that. I don't think any of us are really gung-ho on a naked selling Strangle premium going into an earnings event. But hey, I don't want to put words in your mouth. Maybe, Russell, you're a diehard premium seller. I don't know. But still, a lot of interesting stuff. Who knows? Maybe Russell will give you pride of place on this one because you love to walk people through the numbers. Why don't you walk our friend Adam S. here through the correlation between implied vol and a move in a stock before earnings?
Well, I'm in the process of doing a year-long study about this with the stocks that have weeklies. And so far, I have found if you do nothing but sell straddles or strangles, and this is really based on where the stock closes relative to strike prices, or you go out and just buy a straddle or a strangle in front of earnings, you basically doing either lose money, and you lose money pretty close to the bid-ask spread. So what I'm finding is that the market really does efficiently, the option market does a really good job as a blanket statement pricing in what happens with the stocks around earnings. Now, there are surprises where we get a stock that moves an awful lot, and then there are surprises where we get a stock that doesn't move as much. What's interesting about Apple, the first part of that question was last week, you had a lot. Apparently, several of Apple's suppliers had come out with negative, either negative earnings releases or had been saying that they were seeing slowing business trends. So the feeling was Apple's stock that we were going to see a poor earnings release, which we didn't. But the question pointed out that the implied volatility of Apple options really were not pricing in that big of a move, and it turned out to be correct. We got earnings from Apple, and it was almost a non-event from what I recall. I think the stock traded up $2 or $3, and it was a smaller than average move relative to the 3-year history, and the option market seemed to be pricing that in, even while all the talking heads were making much ado about nothing, what turned out to be nothing with respect to Apple's earnings.
Yeah, Russell, this is one of the things that I kind of hit people over on the head over and over and over again. There's so many people out there that are saying, go out and sell earnings condors, go out and sell earnings strangles, go out and sell earnings straddles. It's a crapshoot, and the market does a decent job of pricing itself efficiently. So, and there's been multiple studies on these types of things, and I'm really interested in how this thing works out with the weeklies. I think it's going to be pretty spectacular. But if you're one of these people that goes out and sells out of the money strangles or near the money strangles or whatever, you're asking to blow yourself up. And one of the things that's left off of Russell's study is that Russell studies have endless supplies of capital, and most people don't. And one thing I think would be fun, Russell, is to look at kind of where weeklies are active and where kind of the retail public is active. I don't know. They probably don't have. They have a report that kind of not the old odd lot, but the small lot trader or some sort of retail-y report out there that. My guess is that the retail-y stocks, the hot stocks, are that everyone likes to sell these strangles in are the ones that are blowing people out. I've seen Google do it to a couple of people this cycle. Earnings are a nuanced trade, and they should be developed around trading around the volatility and buying and selling pieces of it to form a volatility or directional opinion. They shouldn't just be blanket sold or blanket bought. And if that's what you're doing, you're asking to tread water and or blow yourself out.
I should mention our friend Adam S. has written in a few times. He apparently likes himself some Strangles. He wrote in again, I think it was this morning, talking about another one that is even more rocking and rolling. This is Valiant Pharmaceuticals, VRX. He wanted to know, with an implied vol of 118, should he sell a Strangle? He likes his Strangles. I think you can glean from that, Adam, where we lean on just naked outright selling Strangle. If you must take that approach, then please do it in some sort of risk mitigated fashion, Condor, Iron Butterfly, whichever way you want to go. But make sure you have something capping your risk, because even look at a name like Valiant, this thing has just been all over the place of late, and we really have no idea where it will be tomorrow. And if you come in, you try to harvest, a Strangle for whatever, $3 and it looks good, and then you got a 30 handle move in the underlying. If you didn't cap that risk, that could leave a serious mark on your portfolio. So please do not do that. If you glean nothing else from this show, at least define your risk at the outset so you can at least sleep at night a little bit better. Let's see, we got time for a few more here. Always fun ones, like to put you guys in the hot seat. This is the question, kind of a variation we get a lot. This comes from Pick 6. He writes, hey, are there too many VIX-related products? Have any of them ever failed? And I think with a lot of these questions we get more apply to the kind of what I tend to refer to as the VIX universe, which is, the myriad ETPs out there that have been listed on or around VIX. You have the 2x bullish, 3x bearish, inverse this, et cetera, et cetera. Of course, you have the VXXs and others out there. It is a enormous universe of products that seems to be growing almost daily. We've talked about the VIX up, VIX down. I think if you guys listen to the show for any length of time, you can probably glean Mark's and I's opinion on the fact, are there too many of them? I mean, you're starting to get into the point where you have things like the VIX up, VIX down, which attempt to deliver, that spot VIX. And we've talked about how it has pretty much for the most part failed to deliver that with some very, very arcane calculations and distributions and rebates into how they deliver all that. And it's been when you get into that point of the curve, then maybe there are indeed too many. In terms of have they ever failed, we spoke infamously on the show about the infamous TVIX. That's probably one of the biggest volatility implosions, blow-ups, product failures, call it what you will, that I can think of, at least in recent history in the volatility space. Of course, there were some issues with the distributions, and there's a huge flow of funds in and out, and it was a huge problem. The product just got destroyed as a result. The terrifying thing is apparently people have a very short memory in the volatility space because TVIX still trades very actively. If you're not familiar with it, this is one of those inverse ones, a ratio one. This is the daily 2x short VIX, and as we speak today, it's already done about a little over 12 million shares. So people apparently don't learn from recent history, and these products, the devil is in the details when you get into these ratios and these weird levered inverse products. And if they're not constructed well, then they're going to have issues. And I think TVIX is probably the most glaring example of that. Mark, I kind of have a feeling I know where you fall on this one, but what's your take here for our friend, Mr. or Mrs. Pick Six?
You know, ask that ginormous seller of Valiant Strangles how that at the 115 strike how they like their naked strangle. Just stay away. And if you're going to trade it, find some smart, protected way to do it.
Definitely on that. What about the VIX products? Are there too many?
Oh, I'm sorry. Yeah. Are there too many? No, but there's too many exchanges. So all this VIX product stuff, it's experimenting to try and find the VIX product because nobody's found anything good yet. Now, if you're asking if there's too many exchanges, the answer is yes. Too many VIX products, the answer is no.
Russell, I'm going to put you in the hot seat on this one. What's your opinion? Could it be the VIX universe of ETPs, or are you kind of the more the merrier kind of guy?
Well, I'm not necessarily the more the merrier kind of guy. I think that there are probably some spaces for strategy-oriented, volatility-oriented indexes, kind of like we have a buy right, maybe something that follows a consistent S&P 500 plus volatility strategy, since we're getting more and more smart ETFs or smart beta ETFs or whatever they call them. So there's probably room for something like that. Back when we were talking about the ones that failed, or you mentioned a couple that had failed, there have been a lot that have failed. There was actually one, we have VXX, which is always waiting between the first and second month. One of the firms actually put a strip of ETFs out that would give you exposure to the midpoint of the first and second and third and fourth, which I don't think ever traded a share. So like Mark Sebastian just said, everybody is trying a lot of different things. I'm going to sound like a company man now, but as far as trying to get direct exposure to VIX, which would probably be the end-all, be-all of funds, the front month or the front weekly future seems to be doing a very good job with that. And I wouldn't be surprised if an ETF provider tries to latch onto that as well. So there's probably space in the weeklies for something like that.
Yeah, I agree with you, Russell. I think that is. I think the VIX weeklies futures, especially now that there should be enough volume to, especially now that there should be enough volume that's being generated by the options to make those weekly futures much more liquid. I think that is absolutely going to be the best way to try and capture what VIX is doing in those weeklies.
All right, yes, good stuff there. Good questions from everybody. I wish someday we'll do like a whole question episode. You guys send in so many. But unfortunately, we have to keep on rolling to our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball. It's the portion of the show where we prognosticate recklessly and sometimes wildly on the future, what the vol gods hold in store. It's a bit of a weird one last week because we had non-farms and on the horizon. We weren't sure what that would mean, where the VIX would be in the morning versus, indeed, by the time we record the show, could be two very different beasts. As I recall last week, I believe Russell was leaning higher, Mark was leaning lower, so that forced me to kind of split the uprights and go pretty much unched And that seems to be almost close to where we are this week. So after all that Sturm and Drang of last week and earnings and Facebook and non-farms, not really, not a huge movement there this week. But we'll see how things play out for next week. And Kevin, since you're our special guest co-host today, I'll give you pride of place. This time again next week, our recording time next week, where does your heart of hearts tell you the VIX cash will be lingering around?
It's going to creep just a little bit higher, not too much. I think we're talking 16 would be my guess, and that's strictly based on anxiousness building into the pending Fed announcement.
There you go. Fed premium working its way back into the VIX cash again. Mark, you think 15 is a new 12, so you think we'll be hovering out here again as well?
Yeah, I think I like 15 as kind of the level that we're going to stick around at. And that was Andrew last week, not myself, by the way.
Oh, that's
just
true.
A reminder.
I gave you too much
my
credit.
Views. Yeah, if anything, I think, right now we're about 14.90. I think we may be 15.5, 16, something like that. Especially, I think we'll see 16 next week at some point, maybe into expiration of the weekly option, just because, again, this non-farm stuff and the Federal Reserve's boobery is likely to cause some sort of market trepidation, if you will.
And Mr. Rhodes, you've debunked non-farms for us, so where does that leave you prognosticating for the future of VIX this time next week?
Oh gosh, there's nothing coming up, so it's very difficult to see anything but maybe a grind lower over next week. So I'm going to say maybe with a 14 handle, but not much lower than that, but not lower than 14.
Yeah, I wish I could just for content's sake find some outlier that I could throw out there to say, it's going to be 12 or 20. But unfortunately, I don't really see that either. So I think if I had to fall anywhere, I'd probably fall in the slight downside camp, similar to Russell. We shall see how it works out. Who knows? Maybe China will get uppity again next week. Maybe something will happen in the Ukraine. Maybe Miss Yellen will start waving her finger around and we'll be in the 18 to 20 handle next week. We shall have to wait and see. Unfortunately, it's all the time we have for the Crystal Ball segment. It's also all the time we have for this episode, this jam-packed episode of Volatility Views. But before we go, as always, let me check back in with my cohorts here, my partners in crime, starting with our special guest co-host, Mr. Kevin Nichols over there at CBOE Live Vol. Kevin, you mentioned CFE data coming to the platform. Any other teases, any other hints you want to leave our listeners with about things they can look forward to coming down the pike from Live Vol?
Oh, well, definitely integrating the CFE data. Next step past that would be execution capabilities there. And looking just past that, hoping to bring in some more futures data from some other Chicago firms out here. So that's the teaser right now. Excited to be part of the CBO team. CBOE Live Vol is looking forward to that opportunity. And if you guys can, please provide feedback and insights on how you'd like to see the data presented in our platform.
And you guys can, of course, surf over to any of those URLs he mentioned. If you guys want the straight-up analytics, Live Vol Pro, probably the best place for you guys to go and check that out for yourself, kick the tires. And selfishly, Kevin, I'm really looking forward to adding that futures data, just from my own perspective when we're doing these shows. It drives me crazy to be able to go into Live Vol, do all my options analytics, and have to jump out somewhere else to grab my VIX futures data, for example, or anything futures options or futures related. So I'm looking forward to that data. It's just going to simplify my workflow so much more. So thank you for that on a selfish level. All right. And Mr. Rhodes, you talked about your non-farm study. You kind of teased a very interesting bit of our earnings work you're going to be doing. Any time frame for when you're going to have some more of that data out there?
I'm going to run it through the fourth quarter earnings, so I'm probably going to stop keeping up with things in February of next year. It's kind of a long-term thing that I'm doing for the academic program that I'm involved in. As far as stuff over the nearer term, as soon as I am allowed to share it, been running a study on the forward-looking nature of the different global volatility indexes. So I'll be able to put that up on the CBOE site the next week or two as soon as I get it back from a guy at Oklahoma State.
Well, I'm not sure if you heard a lot of our earlier segments this year, but back when we had Jared as our co-host, that's an area we've been very interested in for a long time. It seems like, as important as it is, there is really a dearth of research around volatility and earnings. There's been a few studies, Goldman and a few others, about even something as simple as how the straddles have performed versus expectations. So I think any data in that side of the space will certainly be welcome. And I do believe Jared indeed owes me a few studies on that. I paid him a whopping $5 for it, so I'm looking forward to the research from you and indeed from him coming in the near future. And last but certainly not least, Mr. Greasy Meatball, what is coming down the pike in the land of the pit?
Just go to our blog and read our blog every day. We do discussions on volatility and stocks and indexes just about every day. Worth a visit. If you're interested in volatility and you want kind of a mini daily volatility views, then the Option Pit blog, optionpit.com/blog, is a great place to visit.
There you go. Surf on over to optionpit.com. You can check that all out, including all this pit chat we're always talking about. You can join that up and chat with the other crazy pit folk over there. It's always a fun time. And on behalf of the Greasy Meatball and Russell, who is still nicknameless, and our special guest, Kevin, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in such great questions. We'll get to more of them next week, I promise. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.